Hello, investors. It's Don Vandenbord, Chief Investment Officer for Revere Asset Management. Today is Thursday, March 6th, 5:34 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Roundup Daily Market Insight video. Market state, we're in a mild correction. Let me clear something up very quickly about how we identify market state. So these are various conditions of the market and where our portfolio GROTECTION is expected to perform in different environments. And right now, we consider 4 to 8% off of the high in the S&P 500 to be a mild correction. The next level down, we would change to moderate correction if we hit 8% to the downside. And then you see harsh correction, bear market, severe bear market, early bull market, etc. So mild correction where we are right now. So it shouldn't be a surprise to anybody. You can see the trend gauge over here got a little bit worse today. Red arrow for market leaders. We haven't had a 21-21 list for 2 weeks after leaders completely got devastated uh, finally on what we considered throwing in the towel on individual names was on February 21st. Took three starter positions since then. Stopped on two of them, just sold one just below break even, but all bounces are being sold at this point, which is why you see the short term trend versus the 21-day moving average, all indexes below that. Medium term trend, 50-day moving average, all indexes below that. 200-day moving average. NASDAQ 100 joined small and mid caps with its first close below that level today. S&P 500 and the equal weight S&P 500, the RSP, undercut and reclaimed the 200-day moving average. So a line in the sand for now for the S&P, but we've been drawing several lines in the sand. 100-day moving average, 150-day moving average, and now 200-day moving average. And they all keep breaking to the downside, nothing more than a 1 day rally. And gaps up getting sold. Gap down today. Did you expect it to get bought up? It wasn't. Had a little morning rally above the high of the opening 30-minute range, but then that turned tail and sold off pretty harsh. Bounce and a consolidation into the close, but not a market to be a hero. Our low beta we've been losing less than the market. We know historically speaking, unless you break the 200-day moving average, the market never gets into serious trouble, but we're kind of at that level right now. It doesn't mean a bear market as defined by down 20% is going to happen, but they all happen under the 200-day moving average. Right now, we're 6.6% off the highs for the S&P 500. Our portfolios are about 8% off the highs, and we're down to just gold and a non-leveraged index hold right now. So what happened today? Sell-off continued. NASDAQ 100, as I mentioned, breaking the 200-day moving average, while the S&P and the equal weight S&P undercut and reclaimed, so holding for now. Here are the numbers. The big eight, ugly, all eight down 3.7%. RG8, all eight down, also ugly, down 3.2%. S&P 500 gap down 1.3%. Rallied a bit in the morning, as I mentioned, but rolled over in the afternoon before some consolidation into the close. We'll take a look at the rest of the indexes when we get to the charts. Global 60/40 stock and bond down 1%. Our flagship GROTECTION portfolio down about 1.07%. So here we go into the charts. S&P 500. So 2 days ago, we bounced at the 200. Next day, didn't make a lower low, reclaimed the 150-day moving average. So that was a start. It was day two of a rally, actually. And then today, undercutting the low from 2 days ago resets the rally count. So we undercut the 200 and, as I mentioned, rallied slightly. There's a lot of ping pong. Let's take a look at a 5-minute chart here. You can see the 200-day moving average is like right in the middle of this formation right here. So we were playing ping pong above and below the 200-day moving average, tightening into the close. We'll see bulls obviously want to reconcile to the upside. That's what we're seeing a little bit after hours. but it's after hours, it's thin, and we got a long night, and who knows what other headlines. Well, I do know one headline that'll hit tomorrow at 8:30 Eastern time will be the non-farm payrolls report. So we'll see what the reaction is to that. So look, go to the equal weight S&P very quickly. Same situation, undercut and reclaim closed just barely above the 200-day moving average, continuing to show relative strength over the last 3 weeks because the big stocks in the market cap weighted NASDAQ 100 continue to lag down 2.75% today, breaking the 200-day moving average and a closing low, new low for this correction. Dow Jones Industrial Average still holding above the 200-day, the only one of the averages that hasn't touched it, below the 150-day, consolidating over the last 3 days. Mid cap index, lower low, no, not lower lows, lower closing low, but it didn't break the low from Tuesday. And the Russell 2000 small cap also didn't make a lower low intraday, but a lower closing low as well, very extended to the downside. We're at the spot in this sell off where you're going to start hearing the buy and hold crowd say, well, if you it will get a big bounce, and they'll say, well, time in the market is better than timing the market. If you miss the best 10 days of the market, blah, 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 but they'll never mention anything about these big sell-off days. They never exclude the sell-off days when quoting their stats. It's just a big disingenuous marketing piece for buy and hold, and it's garbage, frankly. But when the market gets volatile like this, the big up days are sandwiched around big down days. It's very clear on a chart to anybody with any common sense that wants to look at it instead of just accepting something at face value. But that's where we are with the major indexes. Let's go to the VIX. Continues to spike, making a higher closing high as the market's making a lower closing low in line there. I mentioned 29, I think, earlier in the week is a one standard deviation from the norm. 19.5 is the long-term average for the VIX. One standard deviation up is about 27. Two standard deviations is around 36. At those levels, you can see how you can just get an astronomical spike sometimes. This was back in July of last year where there was fear of the yen carry trade. But typically those are buy points. We don't dumpster dive, but we're aware of them. They end up like for example, look at this spike up to 28. That's above the one standard deviation move from the long term average, and it resulted in a big move down in the VIX in December. It was a spike up in the index during that. We pay attention to it. We don't trade based off of the VIX. We trade based off of price, volume, and levels. And we're aware when it gets extended. We know what we're looking for. But when you're under the 200-day moving average, that's where the market risk is at its highest. Let's go to the dollar. Dollar continues to deteriorate, not by much more today. In fact, it put in a little bit of a hammer, but it's below all the moving averages. This is normally good for markets, but not with a market sell-off. And what you're seeing is the market is where money flows when there's big global fear. There's not huge global fear right now. In fact, money is flowing into Europe and Asia while the U.S. figures out how the impact on tariffs and the new Trump economic policies are going to impact S&P 500 earnings and therefore the multiple and therefore the value of the S&P 500. But for now, we're seeing money flows not into the U.S., which is the first time for an extended period of time in years that we're seeing this. We've been advocates to stay away from those, but we'll talk in depth on this tomorrow at our podcast, which is recorded early afternoon on Friday and released Friday afternoon on YouTube and emailed out overnight Friday. So there's the dollar. How did that impact precious metals? Weak dollar is normally good for gold. Gold tight range today, down 0.5%, looking good above the 21-day moving average. GDX gold stocks made a higher high, but then pulled back down 0.82%. And Bitcoin not making many headlines, trading tightly the last 2 days, down 1.5%. Let's go to bonds. The broad bond index basically flat today after chopping around four lower closes on the broad bond index. Long bond TLT, three lower closes and a bounce at the 21-day moving average. Um, and here's the yield. Third day up, you can see the yield ran into the declining 21-day moving average. That simultaneously was with the bounce of the TLT off of the 21-day moving average. If we get panic, we would expect to see money flowing into bonds, particularly the TLT is often looked at as a safe haven. The 10-year, the TNX, um, up slightly today. All right, that's our inner asset correlation charts. Let's go to the tail of the tape, the stochastics. Decidedly negative for the RG8 and the indexes. Dollar continues to come down. Percent of stocks against the 5-day still not way oversold. If it gets below 20 or 10, it's a possible short-term bottom. But because we're seeing money just flowing out of growth and into value, that isn't getting particularly oversold despite the deterioration in the indexes. Fear and greed down to 17. So sentiment came out today. AAII, no change in the bulls, 19.4, which is very low. The bears ticked down by 4 and neutral went up by 4. This is a contrarian indicator, which is why we have this is contrarian bullish, which is why we have AAII highlighted in green. On the other hand, these have been out of sync. NAAIM, this is investment managers. This is pretty high, saying they're still 75% invested. It did tick down 13 points from last week, but this can get much, much, much lower. This is saying that investment managers are not selling. Frankly, they're sticking in there. We're on the bear case with the break below the 21-day moving average on February 21st. I mentioned the jobs report tomorrow morning. So the keys coming into today, S&P against the 150-day and 200-day, stayed below the 150, undercut and reclaimed the 200. NASDAQ 100 broke the 200. Russell 2000 making lower lows versus the 200. Day count from up 1 to down 1 and actually down 7 out of the last 10 since we broke the 21-day moving average on 221. That's 10 days below the 8 and the 21-day moving averages with the slope of the decline decidedly negative, and which is where our expectations are until we can collect ourselves and regain the 21-day moving average on the indexes. As far as individual sectors go to the upside today, XLE, which is energy, XLP, the defensive staples, and ITB, home builders. These have been devastated. This is a bounce on the prospect of possibly lower interest rates, which is what the administration is trying to address. To the downside, 9 out of 11 of the spider sectors led to the downside by semiconductors and software. From a portfolio standpoint, sold Nutanix, sold Lilly for basically stopped on Nutanix and the rest of Starbucks and QLD. Lilly, we just decided to go ahead and sell it for less than a 1% loss, but nothing's being rewarded in this market right now. And we trimmed equal weight RSP. So the only things we have left, SPLG, RSP, and GLD. 0.36 adjusted beta with those holdings. To the downside, 1.02% before our stops will get hit. And the bottom line on the day, gap down, we bounced, it failed, we made new lows. NASDAQ 100 broke the 200-day moving average, but the equal weight and market cap weighted S&P 500 both undercut and held their 200-day moving average. Keys for Friday, we're going to keep watching. We'll take the Russell 2000 off here because it's so far below the 200. S&P and NASDAQ will address where those how those play against the 150-day and 200-day moving averages. So let's get to a couple of charts. Here's what we sold, first of all, today. Starbucks, a favorite. You can see the huge relative strength that it had been putting in the prior 4 weeks. Undercut new high and reversed on Monday. First chinks in the armor on Tuesday. Undercut and reclaimed the 21 On Wednesday, we sold half on the undercut and the rest of it on the open below the 21-day moving average and a new low today out of that. But all we lost on this, we're taking very small positions. The loss was 0.12% of the whole portfolio, so 12 basis points, uh, a paper cut, in other words. Nutanix, same situation, lost 10 basis points on this as it broke the 21-day moving average. And Lilly lost 2 basis points on this. And really, it's just a market call. It's holding up fine. Relative strength is holding up fine. But as I said, market not rewarding anything today, except for a few, which I will show. So a couple that have stood out over the last couple of days. First of all, BJ's wholesale club. Uh, Not a gap up, but steady buying after the open. Where did my chart go? Oh, Market Smith crashed. Okay. Let's try that again. Actually, it looks like Chrome crashed. Let's get these charts back up again. Bear with me for 1 second. I think it's worth seeing these. So, yes, I know Chrome didn't shut down correctly. All right, here we go. Back to the charts. So, BJ's, I was saying, on earnings, up 12.23%. So some strength, not much, but we do identify it and we make note of it, and then we see what's going to happen in the days afterwards. Not sure that you're going to ever get major relative strength out of BJ's with their single digit growth in sales, but this is what the market is rewarding right now. On the tech side of things, Zscaler closed at the low of the range, but did gap up 3% above the 21-day moving average on its earnings report. Okta, two strong days, one on its earnings gap, a breakout of the base. On its second day, reversal along with the market, but this one has our attention as well. We're looking for leaders. We're looking for what is going to happen if the market decides to right itself, what has a chance to work. China's been working. Here's JD.com. Broke out on earnings, sold most of it off, but that is kind of a jagged cup and handle. AVGO after hours, up 16%. So this might light a little bit of a fire under semiconductors, especially since Marvell reported the night before and was down 20% today. And let's see, anything else jumping out at me? One we're taking a close look at is the Euro Stocks 50. This is what we wanted the S&P 500 to look like. You note the relative strength on European stocks all year. This is related to the uncertainty in the U.S., the sell-off in the U.S. from higher valuations, much higher valuations than the Europe stock market and the rest of the non-U.S. excuse me, stock market. So that's something we're taking a look at. Here's China FXI, also something we're looking at as that's building a cup base. I think that is it. So again, don't be a hero. Keep your watch list updated and wait for the wind to be at your back, not in your face. It's certainly in our face right now. But again, could get a sharp bounce at any time. This is the type of market where those sharp bounces are sandwiched between sharp sell-offs. So um, you know where we stand on buy and hold forever. We just don't do it because it can be devastating to your portfolio, but we especially don't do it. And what our entire investment process is built on is avoiding these big bear markets. They all occur under the 200-day or 40-week moving average, such as we saw. Here was a break of the 200-day in 2022 before the big rollover, and 28% high to low on that. This is what we avoid. Wait for our shorter term signals to give us the all clear. We'll invest as always, type stocks, never taking big losses. That's our common sense approach to the market. If you're interested in finding out more about it, email me or my partner, Dan Stewart, Don or Dan at revereasset.com. Phone is 855 Real Wealth. That's 855 732 5932. And with that, I will wrap it for Thursday, March 6th. This is Don Vandenbord with Revere Asset Management, telling it like it is. That's Reveritas, combination of the word revere and the Latin word for truth, which is veritas. We strive to provide the market truth, not our opinion, not what anybody thinks. Price and volume is all that matters. Thanks for listening and have a great day.